him a hand. He helped sponsor the meal tonight, so we could get some Chili's barbecue. So,
Kyle, Vince Pace, I manage our ag banking team at First Citizens. Thank you, Kyle. Thank you, Scott, for y'all putting this meeting on. I'm not going to stand up here. Hopefully, y'all got some good information, different from, I guess, my pessimistic view on the ag economy at the moment. But anyway, if any of you guys bank with us, we appreciate it very much. If you don't, we'd love the opportunity to talk to you. We have an ag bank team. I got Will McCutcheon back here with me. Will's a banker on my team. It covers a lot of the northeastern part of South Carolina and even up into southeastern North Carolina. So if we can ever help you guys with anything, please don't hesitate to give us a call. Just a quick update, I guess, on interest rates. The Fed's met several times. They have not lowered, the Fed fund rate at all. So prime's still sitting at 7.5. Thankfully, our equipment and long-term rates on equipment, real estate have trickled down a little bit. We're probably the lowest now we've been, probably 7 or 8 months, I guess. So still not where we were 2 or 3 years ago, but still, I think very, very competitive with anybody else out there. So thank y'all again. If we can ever help any of y'all, please don't hesitate to give us a call. Appreciate y'all letting us be a part of this.
Thank you.
take it away, Scott.
All right. Well, good evening, everybody. Vince didn't do a very good job of setting me up. He's saying, I hope I don't have anything depressing to share, but I'll do the best we can. For those who don't know me, I'm Scott Mickey. I'm an extension economist with Clemson University. I work out of Columbia at the Sand Hill Research Center. I work a lot with producers doing risk management, and part of that is commodity marketing. So what we're trying to do is just do some quarterly updates on the markets as we go through the next year. And I know this is a tough time to start, but just wanted to go ahead and get started while we could. Thank Kyle for arranging everything and the support of First Citizens to make this happen tonight. I was at a meeting this summer, and one of the speakers had this phrase he kept using all through the seminar, and I really liked it. And my wife and I were in Georgia visiting our son a couple months ago, and walked into a little thrift shop, and they had this sign, and it had that saying on that sign, but it added one more quote to it. And what I want to do tonight is just use that quote kind of as our theme as we go through talking about the corn and soybean markets as we move forward. And what was on there was, the first part is cry me a river. Why am I asking y'all to cry me a river?
A lot of crying to be done.
A lot of crying to be done. I mean, what's going on? Why would we be crying a river right now?
Low commodity prices.
Low commodity prices, all right? What else?
High input. High input.
High inputs, low commodity prices. Anything else? That's
I
all
would
it's
say the
worth.
cost of doing business, like
Interest
insurance and the
Okay.
insurance and liability and all that stuff.
No labor.
I was gonna say interest rates, but that kind of could fall under overhead.
Well, Dan's already covered that, so we're safe here. We'll say, yeah, these interest rates are still too high, aren't they?
That is a good point though. You have a line of credit, it's a prime-based interest rate, you were at prime plus 1, and your rate's 8.5%, or was 9.5%, the prime is 8.5%, and you have $1 million line of credit, and your interest expense doubled or tripled from what rates were, that's still, that hurts.
It's an interest.
Equipment cost is another thing, Scott, that's so high. Again, you take a planter these days, costs what a tractor used to, so it's, equipment cost is, yeah, it's extremely difficult to deal with.
I mean, it's trying to replace it, trying to repair it, it's all really pretty steep. And just trying to find somebody to repair it. I mean, we go back to that labor shortage. I mean, it's not as easy as it used to be from that. Got a little assignment for you all that maybe y'all do better than my other groups have been doing, but I just want to get a little feedback kind of where we are. And you don't have to put your name on this, but trying to set the stage, and then we're going to kind of talk through some of these questions I had on here. And if you could just kind of fill it out, kind of give us an idea of where we're starting from and where we hope to end up.
If you double crop soybeans or wheat, that won't apply to this sheet.
Well, if you double crop, I mean, you still have, how many acres of soybeans do you have? You know, you can just put in there that it's double crop. Or whatever, it's fine. Wait, I need a pen.
I only got 12 acres of soybeans. This is their fault. I appreciate everybody taking time to fill that out, and so just hold on to that. I would like to gather them up at the end just so we can kind of benchmark where we are and where we're trying to get to. But, you know, we kind of cried a river, right? We talked about the things that aren't going right, okay? But if all we do is talk about that, you know, it's not going to change anything. And so the second part of that quote that I really like is we got to build a bridge. We need that bridge to get over this river that's causing all of our grief. And so we need to be thinking about how are we going to build this bridge. And one of the things
when I think about a bridge, you gotta make sure you're building bridges that get you to the other side and not just building you a pier that takes you to the deepest part of the river, right? So what we need to be thinking about is how are we going to build the bridge? And so what I want to do is find out what kind of cash corn price would you like to have for 2025? What are we looking for? So if we're going to build this bridge, we kind of have to know where we're trying to get to. So what price are we looking for? Well, we can get that price right now.
Yeah. Right now, we all hope we can get $5.
$5? Okay. So what if we need $5 for corn, or we'd like to get $5 for corn? And so whenever we're talking about that cash price, it's got two pieces, right? We've got the futures price, and to that we add our basis. Anybody know where December corn closed today?
I think 406, 406 or 7 somewhere.
It was up some.
Let's just say, we'll use 407. So in order to get $5 today, what kind of basis are we going to need? 9 cents. Oh. So what we're doing now is starting to think about, well, how are we going to get to here, to $5, when we're starting at 407? What kind of basis do you think you could get right now, if you call it up locally? What kind of basis are people offering?
15 in Dillon and 35 in Lawrenceburg.
15 and 35?
Uh-huh.
Got some potholes in our bridge, I think, don't we? Well, at least now we know what we're battling, okay? We could be watching this for how's this going to change over the next 90 days, next 6 months. We can also be thinking about how that basis is going to change, okay? At least we know what we're shooting for, okay? We've got something to aim for and to think about. So what I want to spend the rest of the time this evening is just talking about where we think this market is going to go over the next 90 days or so you can kind of use that to build your marketing plan as you move forward. Can y'all read that? Okay. One of the things I like to start off with is always just kind of looking at what's crop insurance going to do for my operation this year. And so what this is in South Carolina, the base price for 2025 is $4.66. Okay? That's based against the September futures contract. Okay? Currently, if the crop insurance price was closed out today, the harvest price would be $3.96. Okay? So we've had a drop, and it's about 15%. So when you think about the corn crop that you're harvesting right now or getting ready to start, is your yield about average or above?
I think maybe a little bit above, we're hoping.
Okay.
We're hoping that.
And so when you think about that, if we only have a 15% price loss and you bought revenue protection, we're probably not going to get much help from crop insurance this year. Because if our yield is average to above average, we're going to come in above our crop insurance guarantees. So that's a good thing. On cotton, it's about the same harvest price as it was projected. But on soybeans, looks like a big change, but it's really only about a 3% drop. So we've got the same situation in soybeans and corn. It would take a production loss probably to trigger any kind of crop insurance claims for 2025. Just keep that in mind that, we're probably not going to get anything out of revenue protection or yield protection this year. So the other thing I like to look at when we're trying to talk about what price is going to do is first is the corn's. Oh, man. Pass it. Thank you, Tom. So there's a lot of information on this page. I am an economist, and I don't think he can ever get enough numbers on a piece of paper, and so sometimes I go overboard a little bit. But what's on this piece of paper is first, this is the USDA supply and demand report. It comes out every month, sometime around the 10th to the 12th of the month. The next one is going to be August, or it's going to be on Tuesday, August 11th or 12th, whatever day that next Tuesday is. But what they do is they talk about how many acres of corn were planted in the U.S., what's the expected harvested acres, what's the expected yield, and then we start looking at that gives us our total production, add that to our beginning stocks, and that gives us our total supply. So this yellow column is the 2025 corn crop that you're all harvesting right now. You can see that in the U.S., we expect to have over 17 billion bushels of corn in our supply for 2025. If you look back these last couple of years, that's a lot more than we've had the last 3 or 4 years. That's the supply, and then we also look at how are we going to use this corn? What's the demand for it? And so the first thing is feed. And in the U.S., we're going to use just under 6 billion bushels of corn for feed in the 2025 marketing year. We use about 1.5 billion bushels for food uses and seed. And then we also use about 5.5 billion bushels for ethanol. That's the corn that we use domestically within the United States. The big number that kind of helps with our price moves is this exports. We're projected right now, as of July, we're projected to export about 2.7 billion bushels of corn out of the United States to other countries in the next marketing year. So if we do all of those things, we have total demand of 15.4 billion bushels, total supply of 17 billion. That means our ending stocks will be about 1.7 billion bushels. That's corn that will be left over at the end of the marketing year. Last year, we had 1.3 billion bushels of corn left over. We're projected to increase that to 1.7. So when you end up with more stuff left over, what tends to happen to price? You got a lot of something, price usually goes down, right? And so that's kind of what the expectation is for 2025, is that we're going to have a lower price. USDA thinks the average cash price in the U.S. is going to be $4.20, and this upcoming year versus 430 last year. That's not the price in Dillon, it's just the average cash price across the United States. So we're expecting it to go down. Still trying to think of the non-pessimistic point that Vince wants me to make. But, I mean, this is where we are, okay? We've got more corn left over, and so we expect pressure on prices. In fact, if you look on the right-hand side of your handout, this section right here that says fundamentals, that's looking at the average price of the December corn contract in the month of July. Okay. So since 2013 through 2024, the average price in July has been $4.39. In August, it's been $4.24. September, $4.21, and then we've seen a rebound a little bit into October. So as we're thinking about what's going to happen to price over the next 90 days, I think this is some indication that we will probably see price pressure on through August and September. While I'm on this pessimistic road, this yield right here of 181, that's that's trend line or slightly above trend line U.S. corn yield. Historically, when we've had big corn crops, the August report has been increasing that yield. Not a lot, but maybe 2 to 3/10 of a bushel. And I only bring that up because that's just going to potentially increase our ending stocks. That's not to say that's what's going to happen, but historically when we've had big crops, they tend to get bigger through August and September. It won't be until November, December, or even January when, you know, the final numbers start coming to light. So I say that to be thinking, okay, if we're here at 407 today, what's it going to look like for the next couple of months? Are our pricing opportunities going to get better, or are they likely to be tougher?
Tough for 3 months anyway, probably longer.
So if the price outlook's down, what are you going to do? What are you going to do with this corn? We're wanting to get to this $5, right? And right now, if we're at the 35, we're still 60 cents, 58 cents away from doing that. What are we going to do to try to, you know, maximize our revenue in 2025? Well, what a lot of people tend to do is they like, oh, it's fucking hard to read. Lots of people will store corn, right? Why do we store corn?
I think the base is going to improve.
Think base is going to improve? Okay. Any other reasons? Sometimes we have to do it because, you know, logistically, we can't get it out of the field and to the market in a timely fashion. I mean, it's just unrealistic to try to get it to market in the middle of harvest sometimes. So we like to store it. So if we store it, what we're wanting to do is see, instead of selling against September contract, maybe we can sell it against the December. The price of September was about $3.88, I think, today. And then December was $4.07. So it's about 19 cents to carry corn from September to December. That's why we see these prices with some spread between them. And then to carry it from December to March, there's another 18 or 19 cents. And that's what the market's trying to do. They're trying to incentivize you to store the corn, carry it on into the marketing year. Back in February, you can see that the carry was a lot tighter. At that point in time, they were wanting corn in September more than they wanted in December, because they weren't going to pay you to carry it from September to December. But now that we're here, they're willing to give us a little bit more if we carry it 3 more months, and then again for another 3 months. Is there any cost for you carrying that corn? What I'm trying to, these are my numbers, okay? I'm not saying these are yours, but I think you need to be thinking about these numbers and how they may be reflected in your operation. Well, what I'm trying to do is look at how much the carry is in the market. And so with that, I started with the futures price of $3.85 in September. I was using a basis of 75 over, and that gives a cash price of $4.60. I said to carry it from September 13th to December 13th, it's about 90 days, and December was trading for $4.07. I left the basis the same. It gives us a cash price then of $4.82 and a market carry of 23 cents. But to carry that corn those 90 days are some costs. And one, you're probably going to have some shrink. Not probably, you will. Every time you load a truck, there's some corn on the ground, right? Not when you all do it, when your help loads the trucks. When you all do it, there's no waste, right? But there's going to be shrink because that corn in the bin is going to get a little bit drier. If it goes from 15.5 to 15.25, it has shrunk. You've got less bushels to get paid for. So I'm just using a third of 1% a month. If you take 1% times $4.60, the cost of that shrink for 3 months is about a nickel a bushel. I started with 15.5 on September 30th, and basically lost 1% of that over the next 3 months. It's really costing you a nickel. You've got some utilities to blow air on the corn in the bin or whatever. I'm just using half of 1 cent per bushel per month. That'd be about 2 cents. There's some labor costs. We've got people checking it. You're running by to check it. There is a cost for having to monitor the grain bin. That's about 3 cents over those 3 months. And then you've got the interest cost for carrying that. Because if you sell it and get paid September 13th, you get $4.60. But if you hold it until December, you've had to pay 8.5% on that $4.60. That's about 10 cents. That's about half of my cost of carry. Your interest rate may be different than 8.5. That's just prime, and I was just trying to use a number that was easily found and dependable. So the cost of carry is about 19 cents. The market carry is 23. So if the basis stays the same, we make about 4 cents a bushel carrying that corn for 3 more months. So in this scenario, storing corn will pay for the cost. But you still need to know what your numbers here are. What your shrink may be, what utilities, and so forth. Questions on that? If we carry it on out to March, gets a little tighter. We've got 40 cents of carry, and if the basis doesn't change, we've got a cost in of about 38 cents. 2 cents gain on that. And if we carry it out till May, at that point, the cost of the carry starts exceeding what the market's willing to pay, unless the basis does improve. So think about, is basis likely to improve in 2025 in our area for corn?
It usually improves a little bit after the harvest season. The past years,
I think the
We've
problem-
got an above average crop, and so they know people are more likely to store. The whole point of basis controls the direction the grain's moving. If I need grain to come to me, I increase the basis, and that pulls it in. If I'm full, if I don't need any more, I lower my basis, and that pushes it somewhere else. So the one thing I think is important is to be monitoring that basis as often as you can. See what they're offering, see what it's likely to do, see if there's a difference if I'm booking 50,000 bushels versus booking 10. Sometimes they give a little more for a larger quantity. But just kind of know what that basis is and find out, does it make sense for me to carry this? Am I going to get rewarded for storing that corn? The good news is last week when I did this talk, these were negative, right? Based on where the prices are. It was actually costing more to carry corn than it was. So again, that's these prices as of today, but you need to watch what this market carry is doing, because if it drops from 23 cents back to 20 cents, that carry may not cover the cost of getting it. One of the things that I like to look at is on USDA's website, the South Carolina daily grain bids. You can see in the country elevators, Darlington, see Darlington is 25 over the December contract for August, September delivery. Lake City was 25 under. And Lynchburg was even for September. But that's another way to get it. I don't think this is necessarily the basis you get when you call. This is the basis those locations report on a daily basis to USDA. Oftentimes, they're a little bit lower than what you will get when you call, try to lock in your basis. But if you look at them week after week, you kind of see what direction things are moving. Right now, they're only offering bids for August and September. Once we get through August, they'll start having some December basis bids as well. But that's a good resource to try to see what's happening with basis if you're not calling them directly. Questions on the basis bids? Let's see, so Cassett was 50 over for December. That's for October delivery. Anyway, questions on that, of what we can kind of expect. Those bids were not any different than they were last week. Okay? I did check the end of July, these were the same bids they were offering. They're offering the same bids then that they are today. So keep an eye to see if that basis is changing or if it's getting better. This is the December contract. You can see we've just been pretty ugly since middle part of April. It's been trending down. We really do not have any support under this market. We haven't traded this low on the December 25 contract since it started. Okay? So sometimes we like to see a trade, down here and think that will give us some resistance. That'll slow the market. But right now, there's not any stoppages under it. Okay? So you want to keep an eye on what's happening to the futures price as we move through this harvest, particularly if this crop keeps getting bigger. So what can we do? Been full of good news. The second page of that handout that I gave you, it has a few marketing strategies on it, and I just want to talk about the first two. Okay? The one thing we could do is we could go ahead and sell the futures against December at 407. Okay? We could lock in a 407 price. Okay? What's good about that?
You can wait on the basis to change it. I mean,
At least the futures part won't get any worse, right? If we go ahead and lock some in at 407, we will set that price. But if the price does go up, we're kind of stuck. We're still at 407. Okay? So if the basis was in your favor and 407 got you to your target price that you want, this may be one thing to do. Just go ahead and sell it to the mill and be done with it. The upside of doing that is you don't have any carrying cost, right? You would have all the cash in September sometime, and there'd be no more interest on that money. You could pay down operating, pay down any other bills that need to be paid down that are costing money. There wouldn't be any more shrinkage. So you would stop some of the expenses from storing corn. That one just doesn't really feel good. I admit it. It's just hard to think about that. Another strategy you could do is you could buy a put option. And what a put option does is it gives you a minimum price, but if prices go higher, you can benefit from the price rally. If prices go lower, you won't go any lower than your minimum price that you've set. Okay? So the December contract was trading at 407. We could buy a $4.10 put. It would cost 18 cents to buy that insurance, but it would give us a minimum price of $3.93 plus your basis. So if prices do rally, you could possibly get more than $3.93 for your corn, but you wouldn't get less than that. That's $3.93 plus the basis. Do you like that idea better than just flat selling it at 407? There is no right answer to that. Okay? You have to think about what you're comfortable doing. If I sell it, I can stop the carrying costs. If I buy the put option, I still have the carrying costs because I haven't delivered that grain yet. I haven't been paid for it. I just have an option to sell it sometime between now and December. Okay? So actually, I like this better than buying the put option because at least I can stop some of my expenses. That's my preference. You need to think about what works for your operation. Alternatively, what we could do is we could sell the futures or cash sell the grain and then buy a call option. When you buy a call option, it gives you the right to buy corn at a certain price. So if it goes higher, that call gets more valuable, because if I have the right to buy corn for $4.10 and it goes to $4.20, that's worth 10 cents, right? In this case, the December futures are $4.07. I sell the cash, get $4.07, buy the $4.10 call option, cost me 14 cents. My low price is $3.93, the same as if I do a put, but I don't have any more carrying costs. But I'm gonna go ahead and deliver that grant. So I wouldn't have the carry costs, I would get paid the $4.07 up front. I could pay down my operating loan, pay down any bills, but I could stop some of the additional carrying costs for holding on to corn. So that would be one thing to consider. Among these three options, these three strategies, I like selling the cash and buying call options better than buying the put option. I think it gives you less expense and still capture upside if the market does move higher into November, December, and into next year. If I can get the basis I need and 407 gets me close to the price that I need, I'm also fine with just taking 407 plus my basis and me and saving the 14 cents that the call option costs. Questions? Let's talk about soybeans for a few minutes. This is the same information, supply and demand. The difference for soybeans is that we have a lot fewer acres, so our production is down from, well, let me back up. We had 3.5 million less acres of soybeans planted in the U.S. this year. But our production is only expected to be down about 30 million bushels. Because that expected yield is going to go from just under 51 bushels an acre last year to about 52.5 this year. So we have less acres, but we really didn't see a drop in our production. Total supply is about the same as last year. Soybean uses include crushing it, making meal and oil out of it. Use about 2.5 billion bushels of soybeans for that. Use 110 million bushels for seed. And then we export we're predicted to export about 1.7 billion bushels of soybeans in 2025. So our total demand is about the same as last year, up slightly, but our ending stocks are down about 40 million bushels. Expected price, USDA had it at $10 last year. Expect to be up a little bit, 10.10 for 2025 across the United States. When we look back at this seasonality, the last 11 years, July has averaged $11 as the average November soybean price in July. August is $10.75, September $10.78, October $10.71. We really don't see in the next 90 days much historical price appreciation on soybeans. So again, smaller stocks, but historically we just don't see a whole lot of price improvement. So what are we going to do on the soybean market? Let's talk about carry again. Soybeans, I'm looking at if we've got those beans in the bin in November, Currently, that futures price is $9.93. When I looked at the South Carolina grain bids, the basis is around 50 cents under. What kind of basis are you all hearing for 2025?
Hadn't really looked much myself, like, I mean, last I looked, it was either even or what? CNN was paying like even or the port down here in the port.
Okay. Do you think base is gonna be better in 25 than it was in 24, or worse?
I think it's probably close to about the same. I think it's probably close to about the same. I think there's probably less acres of soybeans planted.
From what China's situation is.
Okay. I think one of the other things that's got me a little nervous is with Kershaw closing. That's 4 to 8 million bushels of soybeans that's got to find a different home. And so, remember when I said basis controls the direction? Well, everybody that buys soybeans potentially has another 4 to 8 million bushels of South Carolina soybeans could be coming to them. I hope I'm wrong, but that's kind of how I'm thinking through this, is there are more beans chasing, or if it's the same amount of beans or slightly less beans, they're chasing fewer holes. So I hesitate to think that basis is going to stay, at the same point as last year. That's just my opinion. I've been wrong. But that's what I'm thinking as I'm looking at what's going on in the next 90 days. If I have an opportunity to get a basis similar to what I had last year, I'll weigh that in there. Do I want to take it, or do I want to try to gather another 5 or 10 cents on basis? So just be thinking about that scenario. Other thing that concerns me is that Bayer dropped a lot of their seed soybean contracts in North Carolina and in South Carolina. So there aren't as many people growing seed beans this year. And so those bushels are also looking for a different home. That's not the same volume as what Kershaw plant's closing has, but again, it's potentially more soybeans looking for a new home than in years past. So keep that in mind, just follow up on what soybean basis is doing. Again, when we look at the carry, I just use the same basis going out. Carry is about 19 cents from November to January, 36 cents out to March, and 50 cents out to May. At the same cost, shrink, we use a third of 1% a month. It's about 6 cents carried into January. Same utilities, same labor. The interest cost is more because a bushel of beans is worth more than a bushel of corn. So we're looking at 14 cents of interest cost by carrying beans from November to January. So if these numbers are correct, you can see that carrying beans does not pay. It's got a cost of about 23 cents, and unless basis approves, we're only getting 19 cents per carry. So if you've got a limited bin space, which crop would you rather store? Soybeans or corn? Right now, I would say corn because it's at least covering its cost to carry, and beans don't cover them in any of those scenarios. So basically, we need to get a 5-cent increase in basis from November to January to justify carrying the beans. We need a 10-cent increase to March and just under 20 cents to carry them all the way back. So again, looking forward, Soybeans, we don't see a whole lot of futures price improvement for the next 90 days. We could see some issues with basis, particularly compared to last year. So you just need to stay in contact with who you sell to and monitor what the basis is doing and try to, lock in the basis that's going to be favorable for you. Questions on soybeans? Went through that one a lot quicker, but I think we already knew we'd rather store corn than beans most years anyway, but this is just kind of the reason why. Any questions? So here's the soybean market. Unlike corn, we do have some lower prices back here in early April. We were in the $9.75 or so. We closed today up because we did have some improved export commitments get announced today. That was the big reason corn and soybeans closed higher today. But if we see soybeans start breaking below $9.75, we're going to be in a similar situation as our corn. There's not going to be any support to keep those prices at the levels we're at right now. So keep an eye on what happens to soybeans the next couple of weeks as we move through that. These are the same scenarios that I talked about in corn, but for soybeans. As of today, we could sell them in the futures price was $9.94 plus or minus your basis. You could lock that in. We could also buy the put option. A November put at the money would be $9.90. It's going to cost you 25 cents to buy that put. That gives you a minimum price of $9.65. If we go ahead and sell the beans, cash contract them, or sell the futures, and then buy the call, we come into the same scenario. We can collect the $9.94, have a strike price of $9.90. It costs 29 cents. That gives us a minimum price of $9.65. If beans go higher, you would also collect more money for the soybeans. Okay? Just like in corn, if we do this strategy, you can stop your carrying costs, once you get those beans delivered. So again, I think this gives us upside potential, but it does stop the additional costs of storing soybeans for longer periods of time. Questions on that? What questions do you all have? So I talked about building the bridge. And I think the last part of this is you gotta get over it. Sounds kind of harsh, I realize it. But my point is, we know that there's a river of troubles flowing down there, right? We've talked about, or I've talked about some different ways to build a bridge to see, where we're going to end up. But at some point, we got to pull the trigger. We've got to do something to get over that bridge, to get over some of these troubles. I think the one thing too you can always look at, you look at 2026 prices. Are they better than the current prices we see for 2025?
What did you ask us?
Do you think the prices for 2026 crops you haven't even bought seed for yet, are they better than the 2025 prices right now? They could be. I didn't look at them today to see where they were, but last week, corn was trading for 2026 in the 450 range. It's probably down 10 or 15 cents this week. Soybeans are trading higher than they were. So one thing about getting over it is, one, we can also start making plans for 2026. We can be looking at supply and demand and thinking about what's that crop going to look like. But at the same time, we can't ignore 2025, and that's the one that you've got control of right now. So when I say get over it, we've got to think about what we're planning to do, how we're going to manage and try to generate, the most revenue we can in 2025 from those crops. Questions? Anybody have? Yes, sir.
Well, what are tariffs gonna do to the markets, exports?
So the tariffs right now are on things coming in, right? So the question is, how are they going to retaliate? And it's likely that, we're going to suffer from that. It's still, just have to stay in touch and see what the markets are offering. It was encouraging that we saw some exports locked in today, some additional exports come in. But this was also, that might have been trying to get ahead of these tariffs going in force. I think the tariffs will probably put pressure on our exports. If we have fewer exports, that's going to put more price pressure on us. The tariffs will not be, I don't see them being friendly to corn and soybean prices. Soybeans more so because bigger percentage of our production is exported in soybeans and corn. And then you also have to look at what's happening in South America. There are, I think, today there are 60 to 70% through their corn harvest. Have to watch how is that going. Is it looking good? Because the more production they have, the more options other countries have to find corn and soybeans. So it's hard to. I'm not sure how tariffs are going to help us in that at this point. Dr. Smith, you got anything on that?
I mean, the biggest thing was soybeans. Were you asking soybeans or corn? Soybeans, tariffs in general. In general, but soybeans, China's the main market, and some of the analysis I've seen is that overall effect of tariffs is going to be fewer exports going there. However, if China needs the soybeans, it might be that they get routed through another country, and then to avoid the tariff, and then we're getting a lower price for the soybeans that we do export to another country. So whether it's fewer soybeans exported or lower price, it'll impact the soybeans.
Neither one of them puts more money in our pocket. And by going through another, just for example, we may send soybeans to, I'm just making up, Denmark. I don't think we're sending many soybeans to Denmark. And then China buys soybeans from Denmark. They don't have to pay a tariff. Denmark is not going to offer us as much for the soybeans. So that's the kind of, the tariff still impacts it. We still end up with a lower dollar value for beans. Any other questions?
You predicting corn for next year be cheaper or higher? And the same question also
So,
for next year.
I mean, where we are right now. Well, again, when we look at this chart, the only date in my mind that matters is right here. Right here. I'm not here saying where we were. We can't do anything about that side of it. This is where we're working from.
So what was?
Historically, we see the highest corn prices in April and May. And 3 out of 4 years, the price in April and May is higher than the average price in October. It's about 38 cents higher in April and May, year in and year out, than it is in October. So from that's not getting to the scale, is that price going to be better than where we are today? I'm just saying within the production season, the prices at planting time are typically better than they are at harvest. Significantly better. This past year, the highest price was in February. We had another little spurt in April, but you know, the way we're trending right now, we're definitely going to have higher prices in April and May than we're going to have at harvest. The difficult part was at 455, 460, it just wasn't very attractive. Looks good now, but when we were in the middle of it, that didn't look like a really good place to be. And so one thing we have to keep in mind is if we have 90 million acres of corn next year, have big production, we could see this kind of pattern again. Right now, the December corn price for 26 is higher than where we are for the December 25 price. So we have better opportunities today. I don't know how many of you are wanting to book 2026 corn. Yeah. So I have danced around your question the best I could. I still haven't answered it, have I? And I think the same thing is true for soybeans. It's not 3 out of 4 years, it's about 3 out of 5. Soybeans are higher in June and July than they are in October. One of the interesting things in 24 and 25 is we've usually counted on some kind of weather scare in July. We haven't had it the last 2 years. We have not really gotten any kind of bump from weather somewhere in the country. And so that's probably why we have to rethink whatever this price is in April. When it was at 455, I felt good that, you know, we'd have some kind of weather scare at least to get us back there if we didn't take it, but we never did. And so is that going to be more common? I don't know, but I think the key is kind of going back to that building a bridge. What price do I need for my operation? And at what point during the year do I have an opportunity to start selling something like that? We can't look to find the highest price of the year. We need to find prices that will work for your operation. If you need $5 corn, now's the time to start looking to see if we're going to have an opportunity to get that in 2026. Because if December 26 corn is at 450 and your base is expected to be 50 cents, you know, we have opportunity right now.
So we have an opportunity for what price right now?
I think, let me just,
What was our
I got it right.
objective price?
yeah, let me see, hold on, let me look and we'll see what,
December 26 is 447.
it was at 447. So December 26 is at 447. If you can get 50 cents over, that's $4.97. That's not quite $5. if you're getting 60 cents over, you're over $5. So depends on what kind of basis you think you're gonna have in December of '26. Other thing is if, December's at 447, September was probably like 440,
439, yeah, 440.
440. I would be more interested in selling 440. Right now, we've got a plus 7 cent carry. And whenever corn went to like plus 12 cents, I might roll from September into December. If I can still get that 50, now I'm at 452 plus 50 cents. I would probably be looking at a September starting point rather than December if I was looking at 2026. And looking for opportunities when that carry gets into that 12, 15 cent range to roll up to reward the market for offering carry. That's a lot to take in. I'm just. I think the big thing we've got in front of us is our 2025. If you've got 75% of it marketed, maybe you do want to look at 20 cents. If you've got 0% of 2025 marketed, I think we need to be looking at how we're going to get through this 2025 year. So. I've got 8 o'clock. I was trying to be done. I will be around if you all have some more questions. If you have some cotton questions, peanut questions, this is the menu. Right? But, no, I appreciate Dr. Nathan Smith riding up here with me today. And you know, I don't want to keep you on there. You've got a long day already. I got a long one tomorrow too. Have more questions, we'll be glad to try to answer.
Well, we've got a lot to be thankful for. We could have worse yields and we could have more cotton.
True. All right, thank y'all.